Hey, this is Matt from Universal CPA Review. Thanks for checking out this video where we're going to run through asset retirement obligations. Now, this is a great video if you're studying for the CPA exam, but if you're also an accounting student or you need to record an asset retirement obligation for your company, then this video will help make it super simple for you. Now, first things first, please subscribe to our YouTube channel. If you haven't yet joined our Facebook study groups, please do so. The link is in the description of this video. And then lastly, sign up for a free trial if you haven't used the course. Our full course is now at a lower price, and we also offer a monthly subscription option that offers full access. So give it a shot. I promise you, it will change your whole approach on how you prepare for the CPA exam. So are you ready to dive into asset retirement obligations? Let's go. We're going to be talking about asset retirement obligations. And we're going to get straight to the point in this video and help you prepare for exactly what questions you'll see on the exam. This is a topic that in the real world, it's very complex and confusing, and every company is going to have to approach asset retirement obligations differently. But fortunately for you, we're going to go through a series of steps that will help you answer exactly the types of questions you'll see on the exam. So our roadmap for this video, we're going to start by touching on the different types of asset retirement obligations and the criteria to recognize an ARO liability. And then we're going to move into an example where we'll go through 4 steps. And these are 4 steps that you perform throughout the life of an asset retirement obligation, right? So we're going to record the initial liability, and then we're going to record accretion and depreciation expense during the life of the asset. And then when the asset's life is up, we're going to record that entry when the ARO is decommissioned, right? So there's a lot of very specific terms related to asset retirement obligations, but trust me, by the end of this, you will know exactly what you need to do. So on the screen are several different types of AROs to know, right? We can see decommission nuclear power site, cleanup around an oil well, removal of land improvements, and then removal of fuel tanks. Right, so way back when, asset retirement obligations started with decommissioning of nuclear power sites. But since then, US GAAP has added other examples that basically says if you operate in an area and you damage the land or you change the land on which you're on, well, at the end of the period or the end of the useful life of whatever business it is, you need to return or remediate that land back to its prior condition. Now, under US GAAP, there's some really specific language for when a company should recognize an ARO liability, right? But it all comes down to really 2 key words, duty or responsibility, right? A company, if they have the duty or responsibility to put the land back to how it was, then if they will incur a cost to do so, that will trigger an ARO liability. And under US GAAP, the company would recognize this liability on the balance sheet. I'll go ahead and give you a simple example. Imagine you're borrowing a friend's car, right? And then you damage the car. Well, before you return the car to your friend, there's this expectation or duty or responsibility that you'll fix the car and return it to its original condition so that when you give it back to your friend, it's like nothing ever happened, right? Now, there's clearly still the damage on the VIN report, but at the end of the day, there's this expectation that if we utilize something and we damage it, well, we need to get it back to its original condition before we move on, right? And that is what US GAAP's all about, right? It all comes back down to duty or responsibility upon retirement of the asset. So when you go into multiple choice questions and simulations, right, you'll probably see examples of AROs related to the examples we talked about. But at the end of the day, it could be just about anything, right? So there will be pretty clear language to help you understand that it's talking about an asset retirement obligation. So now we're going to move into our mental map for the treatment of an asset retirement obligation. So there's really 4 main types of activities in journal entries, and the journal entries are very specific. And if we don't have our mental map and we don't go through this, they will sound confusing, but I promise you this mental map will take you to the finish line for any question related to AROs. So remember at the beginning of the video when I said we're going to get straight to the point and help you answer exactly what you need to know? Well, that's what we're going to do here by going through an example and learning the 4 steps. So here is our example, right? It says Grant Industries acquired a new facility with an oil well that expects to operate for 5 years, right? So at the end of 5 years, the company will have to plug the oil well before abandoning the facility, right? It's their duty and responsibility to basically clean up this oil well when they leave the area at the end of 5 years, right? So 5 years is the useful life of this asset. So if you've already gone through time value of money, you know that $250,000 of cash 5 years from now, it's not the same level of cash in today's present value factors, right? And the question then gives us some information about the risk-free rate and the credit-adjusted risk-free rate, right? So we'll go through those, and then it also says that the company will depreciate the fixed asset on a straight line basis. It then tells us the present value factor to use for 5 years at 8%, and then it tells us the actual remediation cost in year 5 was $275,000. Ultimately, we need to go through the journal entries that the company would record for each type of activity from years 1 to 5 related to this ARO, right? So this example includes a ton of information, but ultimately you'll see how it all comes together and you'll see how this is all covered in our 4-step mental map. So let's start with step number 1, where we need to record the initial liability at its present value, right? So we can see in the mental map, we'll debit ARC, which is a fixed asset, and we'll debit ARO, which is the liability. So essentially, ARC stands for asset retirement cost. It's a fixed asset, right? We're increasing the carrying amount of the fixed asset, and then we're also recording this liability, right? So this is the initial entry. Now you'll notice how it says the present value, right? And that's key, because remember when I said that the cost will be $250,000 5 years from now? Well, we need to calculate the present value of that cost and put it in today's dollars, because when we record a liability on the balance sheet, it needs to be at the present value, right? So our first step is to calculate the present value of the liability. So we'll take that estimated future cost of $250,000, multiply by the present value factor, which is given, right? And that's at 8%. Now there's one other thing we need to know, and that's that we always use the credit adjusted risk-free rate. So in some questions, they'll just tell you that we use the credit adjusted risk-free rate, and that's the only rate that's given, but they can also confuse you by giving the risk-free rate. So what we need to remember is to always use the credit adjusted risk-free rate, right? Because it takes into account the credit score or the risk rating for that company, right? Rather than the risk-free rate, which is very generic and is not related to a specific company. So when we calculate the present value of that liability, which again is the cost in the future of $250,000, but in today's dollars, well, that present value of the liability is going to be $170,146. Right? So our journal entry to record this liability on the balance sheet, well, we would debit asset retirement costs, which basically increases the carrying cost of the fixed asset. And then we will credit asset retirement obligation, which is the long-term liability here, for $170,146. So purely a balance sheet impact here, right? There's no expense yet, and there's certainly no cash cost. So I know what you're thinking next, right? If that asset retirement obligation is currently on the balance sheet for $170,146, but ultimately at the end of year 5, it's going to cost the company an estimated $250,000. How do we increase that liability over the 5 years? Well, that's what step 2 is all about, right? We're going to increase that liability over the next 5 years. So in our mental map, when we look at step 2, it says record accretion expense using rate. So accretion, it's a weird term and it's oddly specific to asset retirement obligations, but basically it'll increase the asset retirement obligation liability, right? And we're also going to record accretion expense. So we'll get to the calculation here in a second, But we can see the journal entry. It's going to be a debit to accretion expense and then a credit to ARO, which is that liability, right? So anytime we credit ARO, it's going to increase that liability, right? And that's what we're going to do over the next 5 years to increase the liability all the way up to $250,000. Now, it's not straight line, right? So this calculation is kind of confusing, and we'll have to create a little table. So to calculate accretion expense to record, we basically take the beginning asset retirement obligations carrying amount, and then we multiply it by the accretion rate, which is also the credit adjusted risk-free rate, which in this case would be 8%, right? So I've already shown you the table, and I'll show you how to build it up, right? So when we look at year one, well, the beginning ARO balance is that initial liability we recorded of $170,146. If we multiply by 8%, that tells us accretion expense based on that beginning ARO liability is $13,612, right? So then if that's going to increase the ARO liability, that means our ending ARO at the end of year one is $183,758. So then for year two, our beginning ARO balance is the ending balance from year one, right? And then if we multiply by 8% again, well, the accretion expense is different in this case. It's going to be $14,701. Add that means the ending ARO is now $198,458. So what do we see? We see this upward trend, right? We're progressing towards that estimated cost at the end of 5 years of $250,000. Right, so if we repeat the process in years 3, 4, and 5, we see that at the end of year 5, we now have an ending ARO of $250,000. And guess what? That's equal to the estimated remediation cost. Right, so that's how we built up the liability so that by the time the company thinks that they'll have to incur that cost to remediate the land, well, we've built up the liability and we're there. Right? So when we look at the journal entries, it's not going to be the same amount for every year, right? We're going to have to prepare these tables, and the question could be focused on any one of these specific years. So if we look at the example journal entry for year one, well, accretion expense would be debited for $13,612, and then we would credit asset retirement obligation for the same amount, right? If they asked about year two, it would be different. And same with the years 3, 4, and 5. Right, so that is the calculation for recording accretion expense. Make sure you know how to prepare that table as well as the journal entry. So moving on to step number 3 in our mental map, this is where we record depreciation, and it's almost always going to be on a straight line basis. Right, so remember how we placed that asset retirement cost, which is a fixed asset on the balance sheet. Well, now we need to depreciate it just like all of our other fixed assets, right? And so the journal entry we record would be the same as any other depreciation journal entry, right? We would debit depreciation expense, and then we would credit accumulated asset retirement cost, which is basically just accumulated fixed asset, right? We have the carrying amount at the gross amount on the balance sheet for that fixed asset. We're building up that accumulated depreciation, so that at the end of the 5-year life, the net book value or the carrying amount is a net of $0, right? We have the gross cost plus the accumulated depreciation, it equals 0. So this depreciation expense table, it looks very similar to the accretion expense table we prepared in step 2. Now I wanted to show you this so you could see how we build up accumulated depreciation throughout the life of the asset so that at the end of the useful life, the asset's fully depreciated, right? But assuming that you're using straight line, we would only need to take the asset retirement cost, which was from step 1 of $170,146, and divide by the useful life, which the example said was 5 years, right? So if we do that calculation, that means annual depreciation expense is $34,029. So this table illustrates how we record depreciation expense each year and then build up the accumulated depreciation from years 1, 2, 3, 4, and 5, so that at the end of year 5, you can see that accumulated depreciation is now up to $170,146. And I know what you're thinking, right? That number sounds familiar. Well, that was the initial liability and asset retirement costs related to this fixed asset, right? So at the end of year 5, we now know that we have fully depreciated the asset retirement cost, right? So that's sort of your check to make sure that you did the calculations correctly. So what's the annual journal entry to record, right? Because remember, under straight line, it's going to be the same amount every year, right? That's different than accretion, which varied each year. So the entry to record would be a credit to accumulated depreciation to increase accumulated depreciation. And then we also would debit depreciation expense, right? A debit just like any other expense. So that's the journal entry to record depreciation expense throughout the 5 years, or the useful life for this retirement obligation. So we've hammered through steps 1, 2, and 3, and now we're at the end of the road, and it's step 4. And this is when the useful life is up and the ARO needs to be decommissioned, or we need to remediate the property, right? So how would this transaction go down? Well, when we look back to the example, right, in the second to last sentence, it says the actual remediation cost in year 5 was $275,000. So this is basically where the company would incur some level of cost to pay some third party or somebody else to come in and actually remediate this property, meaning get it back to its prior condition. Now remember, we estimated the cost was $250,000, but the actual cost was $275,000, right? So fairly close, but not exactly one for one as what they estimated, right? And in fact, it was actually higher. So let's go ahead and look at the journal entry to remediate this oil well. Because remember, they're saying bye-bye to the oil well. We're done with this facility. So because we're now exiting this facility, we can go ahead and remove the asset retirement obligation. Remember, we built it up to a balance of $250,000. So if we want to remove this liability, we would debit asset retirement obligation for $250,000. Now, because the actual cost was $275,000, we're going to actually credit cash or accounts payable if they have invoices from these vendors, right? And we're using the actual cost here of $275, right? So that's why it's a credit for $275,000. Now you notice this journal entry obviously doesn't balance, right? The debit side is short by $25,000. Well, that's because their estimate was short of the actual cost. So when that's the case, the company would record an additional expense in year 5, right? So in this case, we'll call it oil remediation expense, but it can really be any type of expense account specific to the type of asset retirement obligation, right? So we'll add an additional debit for $25,000. So that completes the final entry that the company would record when they remediate the oil well, right? Now, real quick, what if the actual cost was less than the estimate? Well, we would probably go ahead and credit some sort of gain type of account to recognize that the actual cost was less than our initial estimate, right? So if that's the case, we would credit some sort of gain account. Ultimately, the journal entry just needs to balance. So we went through the 4 steps of our mental map, right? And this is basically the journey that the company would face in real life for this asset retirement obligation, right? We started with that initial entry to record the asset retirement obligation, which was the liability. And then in steps 2 and 3, we built up the liability by recording accretion expense, and we also depreciated the fixed asset, right? And then in our final step, which is step number 4, which is the end of the road for the asset retirement obligation, well, we remediated it and we booked the final journal entry, right? So that is exactly what you need to know. You'll see this frequently when you attack the multiple choice questions in simulations.